Welcome to Stocks in Translation, broadcasting from the New York Stock Exchange. I'm Jared Blikre, your host, and with me is the people's voice, Sydnee Freed. Kindly like, subscribe, and comment on Stocks in Translation on Spotify, Apple Music, Amazon, or YouTube. And today we are welcoming back Kenny Glick, the owner and operator of HitTheBid.com. This is his fourth appearance, but no t-shirt until lucky number 5 shows up.
Number 5, I got a jacket.
But we're going to dig into your t-shirt in a second there. But today we're actually going to be focusing on market technicals, which is Kenny's wheelhouse. Our word of the day is gap, that sneaky empty space on the chart that can act like a price magnet. How to tell when the gap is just a trap. And this episode is brought to you by the number 2020. That is the last time, the year, we had a rip your face off to the moon rally in stocks, just like we got off of those April lows. What history says is coming up next. So Kenny, I know you love shorting, great strategy in March, not so much April, but tell me how this is going for you.
Yeah, what the shorting strategy?
Well, yeah, in general.
I think last we spoke was basically the same phrase. Shorting is short-lived and you're going to die. So now,
and yet you're here.
Did you?
That's so macabre.
Well, I learned my lesson. Again, all we ever talk about is life lessons that I've, taken, basically getting my butt kicked from time to time and learn my lessons. And really, the lifespan of the bear market is becoming shorter and shorter and shorter. And I've learned that. So financial crisis, unprecedented.
That was long, though. Yeah. I mean, the pandemic was a tiny slice.
Right. The pandemic was basically 3 weeks. That was like we had the crash, the Tom Hanks crash, as we call it, in the biz, because when Tom Hanks got COVID, that's when the shit hit the fan.
I did not know that one.
That was when that's when oil went to zero, because apparently Tom Hanks controlled the oil market.
It went to negative 40, buddy.
Yeah.
I don't like associating something bad with Tom.
He's like America's sweetheart, the guy version.
I know, there's other stories, but we don't want to get into that here. But yeah, I mean, the enormity of the comeback is now something that you should expect. So when the market was crashing, and when I look at it algorithmically, there were certain levels that we were like, oh, this makes sense. It's going back here. It's testing this level. But once again, that Trump candle, as now it's infamously,
the God candle that we saw on April 9th.
The 12% candle, April 9th, the day that changed the market history. So at that moment, what happened? The shorts got trapped again, and the longs who were thinking about buying the dip missed out. So we've been spending this last month right now in that moment, because the shorts have now I know we're going to get to these gaps. We're gapping up, and they're not done covering their shorts. And the bulls were not done yet gaining their confidence to buy the dip. And we just keep going up and up. And that's why it's becoming more increasingly difficult for this market to even pull back now. So,
but okay, so if there's a bear market, should you just literally try to short stuff that day, the next day, and then immediately buy the dip after that? It just sounds like you should buy the dip if they're not going to last that long.
The shorting goes on usually 2 or 3 weeks before people start talking about how bad everything is. Yeah. There's what's called a blow-off top, or the smart money candle. And you saw that in February. That's why I was I was in tune with this sell-off, because I was waiting for it patiently as a bearish kind of a trader looking to short stocks. But you get this moment where you could feel the sentiment changing. Suddenly we weren't responding positively to earnings reports, and suddenly something that would make the market go up was not making the market go up. And you're like, oh, finally, we've hit maybe a momentary top, because it's usually never a top. Like, there is no top, there is no spoon. And we finally got that selling, and we got down to those levels where we probably wanted to go, and then cardboard guy showed up with the tariffs and all that, and started just exasperating, making that move just much more grandiose. But the shorting usually happens, if you're in the heat of the moment that day, if you were brave enough to short, sure. But you always got to remember that it's going to be short-lived, and now it's the short-lived moment is becoming shorter and shorter and shorter. Yeah.
All right, we're going to segue here, but also keep on the markets theme. Time for the word of the day, which is gap. So a gap is a sharp move in a stock's price that creates empty space on a bar or a candlestick chart, typically due to significant news occurring when markets are closed, but sometimes they can happen when the market is open under a liquid condition. So we're going to put one on the screen, but real quick, if the market closes here and it opens up here, this is a gap. You're going to see that space in the chart. And a lot of times that gap fills the next morning, the next day. Sometimes it doesn't. Sometimes you get a gap and go. And then it's just sitting there, and eventually a lot of times we see that gap, that acts as a magnet. So how do you use the gap in your trading?
Well, I love the gap fill strategy, right? And what we just witnessed is something called the power gap. So
I did not know that one.
We were coming up to resistance in the market where the QQQ, I'm speaking of specifically, we were coming up to resistance anyway, and it was going to put up a fight. I don't know. We can't know now, but we power gapped above it. So when we power gap, that means we've broke the resistance in the gap. So that gap now is above resistance. So it's even harder now for us to even close that gap. But until we break recent lows, then you're probably getting into that gap zone. But because this was such an enormous gap above resistance, that might be the new floor, or as I call it now, generational lows. We may never go down below that area. I mean, I'm hoping.
Irving Fisher might have a few words there, but well, he was a permanently high plateau guy from 1929.
Right.
But I interrupted you, sorry.
No, that's cool. That's cool. But the gap fill has been a great strategy, especially on the way up. So if you see a stock that's making a comeback and there was a gap in that chart from months or years ago, it tends to have an easier time getting that next leg up because it goes right through the gap. But what you're saying right now, according to what we're looking at the market, just to keep it in terms of what's happening right now, this gap, normally you want to look to start shorting stocks above this gap for it to close that gap, but the buyers are just everywhere. And more importantly, the shorters are on the wrong side of this market. So every pullback that this market's happening, the shorters are like, oh God, thank you. Let me just buy and cover my shorts. And everybody who hasn't bought yet is still waiting for the comeback, the pullback to buy. So everybody's buying. So it's very hard to get into that gap right now. But I hope it does happen.
The word gap is just echoing in my head right now.
Mine too.
Wait, so I need to clarify though.
We need
You
a
said,
counter.
you said something about the power gap and you want to bridge. Why would you want to bridge a gap if it went higher? Wouldn't you just want it to keep going if you had the position?
Well,
not if you're shorting, of course.
Well,
but,
yeah. Well, there's a lot of reasons. People want to see a healthy market.
Okay.
Closes the gap. You see if the buyers are still there. Kind of just leads into a volume-weighted average price, like I'm always
VWAP.
talking about. VWAP, yeah. So it's where the most buyers are. So the market technicians or the market, just most spectators or participants, they want to see something that's telling them it's safer, right? So when you get that gap and you come into the gap and you hold it, it makes you feel nice and warm and fuzzy. Like, all right, if I missed that first move, now I could buy now that we've tested the gap. Kind of like this whole market crash in April. We basically tested some real significant levels from back in August of last year, and they held up pretty well.
You said one of my favorite words a minute ago, VWAP, and some people call it VWAP. Legitimate.
You said VWAP. Weren't you the first one to bring it up? You just wanted to bring it up.
No, he said volume-weighted average price.
All right.
And
I just didn't hear the acronym.
I filled in that gap. But so VWAP, you use VWAP in your trading, and this is volume-weighted average price. So, we talk about averages like moving averages. VWAP is generally just anchored to like the beginning of the day, and you take the average of all the trades adjusted for volume, weighted by volume. But you can also anchor it to other points in time. So important market lows, important highs, the beginning of the year, the beginning of a quarter. And then this line, as it evolves, acts as support or resistance a lot of times in price. So how do you use this?
Thank you. That's all. That's my time. No, you just nailed it. I mean, it really is for me as kind of like a jaded, cynical trader at this point, where I'm just looking for proof that the market is kind of rigged. It is rigged. It's rigged to VWAP. And when I see these prices, so basically to expand on your point, let's look at it even more to generalize it. Volume-weighted average price is institutional money. You want to know where the most money went in at a very specific price, because that price is more important. So when you're just trading VWAP, the way I look at it is, if you have a stock that's traveling below VWAP, the institutional trader is saying, oh great, I can keep buying this stock and I don't have to worry about it. But once it gets above VWAP, traders want to beat the VWAP on the amount of stock they're buying. So as it breaks the VWAP, the trader is frantically buying more, especially in this market where nothing really wants to stay below VWAP, breaks VWAP. And even for the newbie who's getting involved in VWAP trading, sometimes it really is that easy. Breaks VWAP, buy it, use the bottom of that last channel as support. And it really has been working tremendously. But again, just to keep expanding, I love anchoring it to moments. That's what I do, 3 months and 6 months to give you kind of like a time frame of last earnings reports.
Sid, are you going to be a beginner VWAP trader?
That's why I laughed when you said beginning
I will
VWAP
train you.
trader,
I
because
could
I was
see
like,
the glint in your eye.
who are these people? Well, so a related question. How do you keep track of all these technical indicators? That's for both of you.
Right.
B, what do you think is the easiest one for a very average investor to start with?
Well, I could show you the tattoo across my chest if you have a second. It's VWAP. That's it. I don't use anything else.
Are you kidding?
There are no more moving averages. I don't use any technical analysis whatsoever. It's just candlestick
You only
prices.
like VWAP?
VWAP, because you can use it on so many different time frames. So I'm using it on minute to minute. I'm using hourly. I'm using day to day, and I'm also using week to week, month to month, year to year. So there's so much data right there in front of you. And then to Jared's point, sometimes you anchor it to a very specific moment. So right now, if you want to anchor it from, what we were anchoring before was crash of August last year, August 7th or 8th, to this last crash to see what it would give us. And it's just a fun way to experiment with what VWAP can show you. But really on a daily basis, it's the algorithmic language of the market's movement throughout the day. It's all you have to look at to really get a feel for what a stock's going to do. And it kind of gives you, I'm not going to say an unfair advantage, but it finally does give you an advantage because you're running with the big boys.
Yeah, the institutions, a lot of times, if they're filling orders, they are tied to whether how much they are hitting that VWAP.
Exactly.
And if they're above it, maybe they're not getting paid as much. So that's why it's ultra important to watch. All right, we need to take a short break, but coming up, we're going to be talking moonshots for the spoos and 24-hour trading in today's runway battle royale. Stay tuned. This episode is brought to you by the number 2020. That is the last time, it's a year, the S&P 500 rallied more than the recent surge of 18% over 24 days. So these thrusts are not common. And over the past half century, we have only seen bigger ones besides 2020. In 2009, that is post-global financial crisis. 2002, that is post.com. In 1982, which kicked off the 80s bull market. So these were seminal events in market history. Do you see, you're not a long-term trader, as I gather, but do you feel the energy there for the months to come?
Oh, absolutely. Just like I said, we've now had 3 power gaps in the matter of like 20 days, which is unprecedented. I'm seeing activity that I've been doing this 30 years. I don't think I've ever seen the bullish activity that I've seen what I'm looking at right now. And again, as a shorter, and as a shorter that's been on the wrong side of these moves quite often, this time I'm not going to make the same mistake. But you have to start factoring in that we're going to all-time highs now. And it doesn't make any sense. And the bears scream, who the hell is buying these up here? Who's not buying up here?
All-time highs are literally 4%, 3% away. That's
right.
Nothing. Like, how hard are we going?
Right, exactly. We're talking like 2 or 3 days. And then the sheep come in. They're like, oh, I guess the coast is clear. We're at all-time highs. It's the only business where things go on sale. And, the common cliche about Wall Street, people run out the door when things go on sale. You're supposed to be looking to buy it cheaper. So they'll come in and start buying as the market is breaking all-time highs. So we're probably going to tack on a little bit more. And I'm looking at, again, I'm more of a QQQ guy than an S&P. We're only, like I said, we're 4.5%, 5% away. If we tack another 10% from here, we're scraping, 570 on the Qs, and that's going to attract a lot more buying. And the next thing you know, we're in next quarter's earnings season, and the demise of Apple that's been written about for the last 5 years, that's not happening. Amazon, those all are going to keep powering their way up, and Tesla's not going anywhere either. So again, just because we had this tariff tantrum didn't end the AI that's coming, or the quantum computing that's coming, or the future. The future is still coming. So this market, it just does not want to stay down. It really doesn't.
Is there any danger or risk with the bullishness that we're seeing and the fact that the bear markets are kind of over really quickly? Is there danger behind this?
Well, the thing is, it's really the bullishness. I see it as a trader. It's really not out there in the mindset. People are still very nervous.
Sentiment is negative, and that's bullish.
Right.
Oh, but if we're back to all-time highs, are we not? Or is it not kind of coming out in the stocks?
Well,
within sight.
Oh yeah, the same skeptics will say the same thing. Oh, there's another shoe to drop. Wait till you see what's going to happen. Wait till we're all going to die. It's the same mantra all the way up. It's all the way down. nothing really changes. When I say that there's such bullishness, it's just from the price action that I'm watching. People are still very negative. They're saying, oh, well, 90-day tariff, well, wait till you see what happens after 90 days. By 90 days from now, it won't even matter anymore because we can tack another 12, 15% from here. And it's kind of bewildering in a way. Like I said, like the speed and the V recoveries that keep happening. I mean, the recovery was over. I mean, the bull market started before even people were writing theses about theses, you know.
It's none of the third declension.
Research reports about the bear market and the recession that was coming, and they're like, oh, I guess not, and they have to rip it all up. So, you know, it's amazing at the speed of the recovery. It can't be.
And we talk to economists on this show, very smart, bright economists, and they're looking at things like port activity and over in LA, and we're seeing all these macro headwinds, but then the speed of the market recovery sometimes seems to erase this. And I know you're not a macroeconomist yourself, but like, you know, this is dinner table conversation. Do people have difficulty believing you, this reformed bearish, you know, trader with all this short experience? Does this have any resonance for people who talk to you?
Well, I mean, I was just talking about this with a friend. You know, some people kind of find my commentary insulting because a lot of all the stuff where the MBAs and the analysts and all these guys who went to school for this.
And you're like, but VWAP.
Yes, because it's sort of started to become meaningless in a way because all those channel checks and all that stuff, once the ships start to rise, all ships rise. I mean, if your stock's not going up in this market in the last couple of weeks, sell it.
Yeah,
that's good
advice right
there. You
there.
got yourself a dud. I mean, absolutely. But the macro picture, you know, it's funny because it's contrary indicator also because generally they're wrong. You know, it's kind of like the Barron's article. When they start writing the articles about
we had a good one.
Right, you want to go the other way,
yeah.
Right? So when they wrote an article, I think it was like,
where did all the bulls go?
Where did all the bulls go? Yeah. Thank you very much. Right.
I got 3 segments out of that. Thank you.
Yes. It's the same thing.
So Sid asked a very great question a few minutes ago about what is the danger here. I was thinking leverage. Do you employ leverage in your shorting or going long strategies? Is it options? Do you like the Qs? Do you do TQ, QQ? Like, how do you approach leverage and live?
Well, I tend not to. You
Okay.
know, I try not to go on margin, and I'm not an overnight trader, so I have limited risk. Even if I want to go on margin, it's just for the day. You know, so I'm not taking overnight risk. We're not really swing traders, but you know, the dangers of this market right now are just not being involved. I mean, I never thought I would see the market come back the way it's come back, and you know,
twice in 5 years.
Right, and since COVID, day trading kind of went away, and it was kind of dead for a while. Plus, when the market goes up every day, you really don't want to be that active as a trader, and that's what I'm pretty good at. I'm like, you know what? If the market's going to start going every day, I'm going to just ease back and just watch it too. And it's much easier to just own Tesla and then trade a Tesla, right? I mean, it's just 100 points in the last couple of weeks. But the dangers, you know, in theory, most of us are on margin because you're generally, you know, let's say you put 30 grand into an account and you're a day trader now, they're giving you margin anyway. You just don't want to go over your head. You know, when you go over your head, you get exposed to bigger risks, and a trade that you might not have been afraid of, now suddenly you have leverage on, your brain's going to be changing and you're going to do something wrong. That's the one peril of it all.
What do you like right now in the market? Stock, sector-wise, what are you looking at?
Oh, I love the Qs. You know, I'm always a fan. And back to that, you know, I love these zero-date options because now you could trade these monster intraday moves with these zero-date options. So for $500 stock, you're trading it for $2. You know, it's amazing. But if I had to pick stock right now, I still, you know, I think I was here last time, Palantir is still my favorite stock. I mean,
all-time highs, recently completed cup and handle.
Yes, and some analysts came on and said this might be the most overvalued stock in the history of ever. I'm going to buy some more then. Thank you.
$1 trillion, here we come.
Yes,
All right.
But I like a company called SRAD. Big fan of the space. They're data analytics, but they do it for sports gambling websites. So live gambling. If you guys are, you know, day traders, you must love live gambling. I mean,
Can we watch it on esports?
you can watch it. You could bet pitch for now. I mean, and these guys are at the games collecting data and making all that live gambling possible for all these other websites. So Sports Radar, That's
Gambling on gambling.
Yes, gambling
Oh.
on gambling. It
Doesn't get any more meta and macro than that.
Yeah, it's still a cheap stock.
All right, we want to get to our runway showdown for today. It is an all-night affair, a battle of the clock between two distinct market styles. First down the catwalk, strutting under the neon lights at midnight, is the night owl, the 24-hour trader who never sleeps, hunting global news and thin volume moves from Asia to Europe, trying to turn the world's headlines into fast profits. But close behind, stepping into the spotlight, is the opening bell trader. It is the hawk, the trader who believes less is more, favoring the clarity, liquidity, and rhythm of traditional market hours with just a touch of extended session action to stay in style. So is the never-ending market cycle really fashion forward, or does it just create unnecessary wear and tear? Kenny, which look will steal today's show?
Well, I'm with the old school guy. I don't want 24-hour trading.
It scares me a little bit.
Yeah, and the liquidity is not there either. And let's go back to the word of the day, gaps. It takes a little bit away from the gap because you do have a little liquidity. Now again, there's not a lot. Not many people are doing this. That's why if I had my way, I would just shut it down right now. It's a failed experiment. We don't need it. We don't need it. I mean, people just need to rest.
Well, that's the thing. It just kind of encourages you to be up all night and worry about things that you might have control over where you might have gotten a little bit more sleep before.
Right. And you might do the wrong thing because over the overnight session, you have certain time frames where the overseas markets are opening up and you'll get these spikes of volume and then they just dissipate and they go back into the trend. So you could be making a lot of mistakes. Plus, you do need to sleep. So I don't.
True.
Yeah.
Sometimes.
But I mean, the markets now, you're actually getting liquidity at 4 o'clock in the morning, which was fine. Can we just shut the markets from like 8 p.m. to 4 a.m. and just give us a moment, right? And you have futures. If you're that much of a degenerate and you need to do something, learn.
That's where I got my start.
Learn about some futures. Yeah, there's plenty of action right there. And you want to talk about action, one contract is like, 1,000
I tried
QQQ.
trading crude oil at 1 a.m.
Yeah, exactly. Plus, you're thinking correctly at 1 o'clock in the morning when you've been up all day. Also, it helps.
My clarification question, does 24-hour trading literally mean a stock never goes into extended trading? It's just running the whole time, or that's not what it means?
I mean, you'd have regular hours like 9:30 to 4, right?
Right, yeah. They call it extended, and then they have it overnight now. So certain platforms, they actually have broke off. They have a little button that you have to click. So you have regular sessions, and then you had EXT, which is extended. Extended was to 8 p.m. And then you had the overnight session now. So it's 8 p.m. into, I guess, till 4 a.m. And then you're basically in the pre-market then. Yeah, so.
I think people need to sleep too.
Right, exactly. Give me those buttons.
We're all on the same page, and guess what? We are out of time. 24 minutes flies here at Stocks in Translation. Be sure to check out other episodes on all your favorite platforms and the Yahoo Finance site. And be sure to leave a comment as well and subscribe wherever you get your podcasts. We'll see you next time on Stocks in Translation.